And for the sake of time, we're just going to get started. I know people are going in and out, but we're going to get going here. Good afternoon. My name is Jill Schneider. I am a partner in the tax department here in Fargo. I'm going to share a quick tax update, and then Shane will cover the accounting update. After the passing of the Tax Cuts and Jobs Act in December of 2017, 2019 is a relatively stable year for tax changes. We haven't seen a lot of businesses make drastic changes. As a result of tax reform, it's been more kind of business as usual for the most part, and then more focus on how the tax law changes will affect the business long term. Looking back at the 2018 filing season, most of our C Corporation banks saw reduced tax liabilities with the new 21% tax rate. And then our S Corporation bank owners also saw some large tax savings with the qualified business income deduction that reduced their pass-through income by 20%. And the new rate brackets combined with the limits on deductions were still beneficial for many of our bank owners. Now that we've had one tax season under our belt with the new tax law changes, taxpayers and tax advisors should be continuing to discuss ways to take advantage of the tax changes. Some planning should be done related to the new meals and entertainment allocation, classification of contributions as a charitable deduction or as a marketing expense, and also the new parking expense limits, to name a few. One area that hopefully most bank boards and management looked at after tax reform was passed, and hopefully is something that's revisited once in a while, is our S Corporation versus C Corporation discussion. The 21% C Corporation rate is very, very attractive right now. The C Corporation rate does not sunset at the end of 2025, like the individual tax changes and the QBI deduction. But there's a lot of uncertainty with the political climate being what it is, and there's a good chance that things could change after the 2020 elections. That 21% C Corporation rate is only as permanent as Republican control of the Senate and White House. And so when we run these analysis, we may want to run a second scenario using a C Corp rate of 25 or 28% for years 2023 and on, and then increase the individual rate and scale back the QBI deduction for those years. This is just to try to plan for the changes that may be coming in Washington. It's hard to predict right now. And then the big questions that a board needs to consider are, what is the shareholder group going to do with their shares? Will the shares be sold, gifted, or held until death, in which case that S Corp step-up in basis isn't as beneficial? And what is the strategic plan of the bank? Are we looking to acquire other banks? Are we looking to sell? Are we going to hold? All these items factor into the S versus C Corp discussion, so we believe this should be an ongoing discussion item with your board. Ramota Johnson, a tax partner here in our Fargo office, will have a breakout session on estate and succession planning, so I just want to briefly touch on this topic. The top federal estate tax rate remains at 40%, but there's a new increased exemption limit, which is $11.4 million in 2019 and $11.58 million in 2020. Currently, the increased exemption is set to expire at the end of 2025. Taxpayers need to consider that to take advantage of that increased exemption, one must gift over the sunset amount of $5.6 million, so it's a kind of a use it or lose it deal. Portability was retained in the new Tax Act, so a taxpayer can utilize their deceased spouse's unused exclusion. And then also we still have step-up in basis, so that assets held at death are passed to the new owner at fair market value. So this needs to be considered as taxpayers determine which assets to gift, because assets with low basis may not be the best to gift. And then for 2019 and 2020, the annual gift tax exclusion is $15,000. Although the current estate tax law is set to sunset at the end of 2025, there are numerous proposals to change the estate tax, and these proposals are kind of all across the board. Bernie Sanders introduced a bill in January of 2019 to reduce the exemption equivalent to $3.5 million and raise that top rate to 77% on estates and gifts and transfers of more than $1 billion. In the same month, Senator Tom Cotton introduced a bill to reduce the estate gift and GST tax rates to a flat 20%. And then in June of 2019, the House Ways and Means Committee passed Measure 3301 that would reduce the $11 million per person estate tax exemption back down to $5 million per person, which would be adjusted for inflation after December 31st of 2022. So this is only a measure that was passed in the House and not the Senate, so it's not law yet. But as you can see, it's important that your estate tax planning is flexible and reviewed periodically. Right now, in many cases, we would advise our wealthy clients to plan or to put a plan in place to use the $11 million exemption, but maybe not pull the trigger yet and actually making the gift. Also introduced in the House Ways and Means Committee Measure 3301 was the extension through 2020 of tax provisions that expired at the end of 2017 and 2018, and that will expire at the end of 2019. These are commonly referred to as the tax extenders. There's talk that there may be some bipartisan support for including some extenders in legislation to fund the government. That needs to be passed by November 21st, but it still seems kind of like a long shot, so I guess we'll just have to keep wait and see on our tax extenders. We're getting kind of used to that. And then I just wanted to take a little bit of time to touch on opportunity zones, since these have generated some buzz lately. Our banks don't generally produce capital gains in the ordinary course of business, so this is more of a tax planning idea for your individuals and bank owners, or a way to defer capital gains on a bank sale, because eligible capital gains include short-term and long-term capital gains and net Section 1231 gains. Qualified zone funds are a vehicle used to defer the tax on these capital gains, and there are quite a few rules that you need to meet to qualify. First, the capital gain has to be generated from an unrelated party sale. Gains that are passed through to you as a partner or a shareholder may work. The eligible capital gains must be reinvested into the Qualified Opportunity Fund, which is a partnership or a corporation that meets certain eligibility and certification requirements, and it must be invested within 180 days. And then the fund is required to hold at least 90% of its assets in a qualified opportunity zone business or property. Banks don't qualify as opportunity zone businesses because greater than 5% of their assets are financial assets. So investing in a bank in the opportunities fund or opportunity zone doesn't qualify. A qualified opportunity zone is a census tract in certain low-income communities that may be experiencing economic hardship based on 2020 census data. So under a nomination process that was done last June, the governor designated certain low-income communities as qualified opportunity zones. So if your investment qualifies, the tax benefit here is that instead of paying capital gain tax on your current year gain, you can invest in the qualified fund and defer the tax on that original gain until the later of December 31, 2020, or the earlier of December 31, 2026, or when your investment is sold. If you hold the investment for 5 to 7 years, you receive a step up in basis on that original deferred gain. And if the investment is made by the end of 2019 and held 7 years, then there's a 15% step up. Another benefit is that the investment in the Qualified Opportunity Fund increases to the current fair market value if the investment is held for at least 10 years. So the gain from that sale of the Qualified Opportunity Fund investment held for at least 10 years may be permanently excluded for federal tax purposes. So here's just a timeline to better illustrate the timing of the tax deferrals and the step up in basis. Let me know if you'd like any more information on Opportunity Zone funds. I know there are multiple groups offering these investments. We also have offerings available through our Eide Bailey Financial Services area of our firm. And then just a little reminder regarding the Affordable Care Act. All applicable large employers, which are those with 50 or more full-time equivalents, need to comply with ACA. The 50 or more employee count is based on your prior year, but if you have a business acquisition in the current year, you need to look at your count after that acquisition. And then also, if you are not a large employer, you may still have the ACA filing requirement if you're part of a control group or if you have a self-funded plan. We've heard that the IRS is sending out prior year notices, and these penalties can add up pretty quickly. We've also heard that insurance companies and state bank associations are sending out forms that are only partially complete, and the taxpayers are sending in these forms, so they're creating notices. So you need to look over your forms you receive from the insurance company before you file them, and let us know if you need any assistance with that review. Okay. Lastly, I just wanted to mention that the IRS continues to step up their scrutiny of cryptocurrency transactions. A new revenue ruling was recently published, and the IRS FAQs were updated. The revenue ruling stated that if you have a digital currency, and that digital currency has simply changed the ledger that it's recorded on, and your wealth position hasn't changed, then you have no income event. But if the transaction results in an accession to wealth, then it is taxable. In July of 2019, there were about 10,000 letters sent out to taxpayers with virtual currency transactions as part of a first installment. So that as they get more information, the IRS plans to issue more letters, and some letters may require response from taxpayers, and if those taxpayers fail to respond, then they're likely to be reviewed for a possible exam. There's also a new question added to the individual tax return for 2019 that asks, at any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? So just know that the IRS is working to better track virtual currency transactions. And with that, I will turn it over to Shane for a quick accounting update.
When she says quick, I'm going to try and make this like my 2-minute elevator speech on audit and accounting updates, because I think everyone that's not a CFO in the room probably will glaze over most of this information anyways. I just want to touch quickly on the regulatory environment. Our regulatory panel already hit on the community bank leveraging ratio, so I'll skip over that, but stay tuned. January 1, 2020, that'll be effective, so something that we'll be able to apply here in the very near future. As part of the Regulatory Relief Act, obviously there's been some reduced call reporting, which many of you probably saw here in March and in September, this being kind of the first quarter where it's implemented. So hopefully those that are involved in the call report process really enjoyed filling out the call report this quarter, just with the reduction in the reporting. A lot of those items moved to a semi-annual reporting period versus on a quarterly basis. And most of the banks in the room, I think every bank in the room is below $5 billion in assets, so you get to opt in on Form 51 and can elect to complete the short form. So good news from a regulatory relief standpoint. I spent a lot of time doing call reports and enjoyed it this quarter a lot more than I have in the past. We have gotten some questions on the FDIC assessment credit. Most of you probably got some sort of notice from the FDIC that an assessment credit will be given since the fund reached a certain threshold, and so that credit was not reported on the June 30 invoice, but we'll see it here on the September 30 invoice. And the important thing to note is that the call report instructions actually provide guidance in terms of how to record that assessment credit, that you can apply it to your estimated expense here for the third quarter. Any carryover can continue on to the fourth quarter as a direct offset to the liability and an offset to the expense. So don't carry it as a receivable or anything along those lines. Use it to reduce the liability. From an accounting update and really an accounting standards update, a lot of significant items on the pipeline that I can't get in within the next minute or two. But the biggest thing is, the FASB recently pushed back the implementation dates on some significant standards, specifically the ones related to leases, hedging, and our favorite CECL. So they've deferred it essentially a year for those standards, and so for most of the banks in the room. It gives us another year to really assess what the implementation effects will be. The two that I'm going to touch on, and I'm going to, I think, in the interest of time, just kind of fly over leases and CECL, but I'm going to talk about revenue recognition and our financial instruments because those are effective here this year. So if you are subject to an audit or financial reporting, you'll have to assess this at some level or some degree. And you do see it in the call report from a financial instruments perspective, and I'll get into that here very quickly. So from a revenue recognition standpoint, really what FASB was trying to do was try and create some comparability from a revenue recognition perspective across industries. There's a diversity in practice with kind of the industries really driving how they recognize revenue. And they wanted to try and make a consistent framework that could create comparability amongst industries. And so what they came up with was a 5-step process for recognizing revenue, which is really identifying, it's kind of performance-based. And so it's looking at, when have we substantially completed our performance to where we can recognize the revenue. Now, from a banking perspective, this impact is not as significant as it is for, as we think about our clients at Eide Bailey, our non-banking clients, where we've got things like, warranties or returns and things like that. There is a substantial amount of gray area involved. So from a banking perspective, this has less impact, mostly due to the fact that they scoped out interest and investment, or interest income on loans and investment income. So those are not applicable, or this new revenue recognition standard doesn't apply. Probably the most significant area that would impact our banks here in the room is on sales of OREO or seller financed OREO and the recognition of that. It goes from kind of a bright line test of here's our initial investment based on the type of real estate it is, and then a continuing investment to really taking more of a, we'll call it a qualitative approach to recognizing that OREO sale to saying, okay, well, when have we substantially transferred over that risk and performed, and are we absolved of that risk? Some of the common revenue streams that are scoped in, service charges on deposits are also scoped into this new revenue recognition standard. And, we think, or the commentary that's come out of a lot of accounting organizations that have talked about kind of the potential impact from service charges on deposits, so we don't believe it's going to have a significant impact or material impact at all. But look at how your service fees are structured, make that determination of what have you done to perform, or tie your performance as as the depositor to where you can recognize that fee income. Interchange fees are scoped in, but again, that's usually on a point of sale basis, and so those are relatively low impact. I would say the other significant area that would potentially have an impact is if you have an insurance agency. And so you think about the performance of closing on a insurance policy. Right now, the way that most of our insurance agencies are recognizing that revenue, it's basically as those premiums are coming in, you're getting some sort of form of payment from the underwriter or the insurance company that for your commissions. Really, your performance as an agent is complete when that customer signs that insurance contract. So you're essentially going to be front-loading that insurance income versus seeing it kind of trickle through as that policy is paid. Financial instruments, there's a lot that's in this standard, but really the part that's maybe applicable for the banks here in the room relates to equity investments. And essentially what's happening with our equity investments is we're moving it from a available for sale classification to similar to what we do with trading assets. And so any changes in valuation is going to run through your income statement rather than through unrealized gain or loss. And so probably for most in the room, the most applicable or best example of that is Farmer Mac stock, where, we've got an observable market price that you can go out on, Bloomberg or Yahoo Finance. You can see, what that stock price is, and you're adjusting that valuation. What we'll do is we'll do a one-time adjustment to move that unrealized gain loss into our retained earnings, and then going forward now, we'll recognize any changes through earnings. And you'll probably see that as you will see that as a line item on the call report now, that there is a equity investments earnings gain loss on the income statement. Also scoped in is equities without readily determinable fair value. FHLB stock and Federal Reserve Bank stock are scoped out, so we don't have to try and determine some sort of value pertaining to that stock. But if you have other Bankers Bank stock, like United Bankers Bank being an example, they might have some sort of observable market price that we might be able to take a write-up in our value. There is a practical expedient here, again, that those, if it's a challenge or it's difficult to obtain an observable price, that we can use that cost less any identified impairment. I'm going to just go ahead and move through leases and CECL because of the fact that they're kicked down the road. So I'm going to kick it down the road, and we are going to take a break. Before we do, that the code to check out of this session is power with a capital P.
And you should be using your app for this. So I know some people have been texting in it as questions. So you go into your app and go into the section that you're in, and then that's where you put in your code words. So you'll see where it says check in and then also check out. So I know there's been a little bit of confusion. If you have questions, the desk out front, if you want to go out there and ask them questions. And make it 5 minutes for the break. We're a little bit behind, so if you can head to whatever breakout you're going to, will be good for that.
Perfect. Thank you, guys.